SGX Nifty this morning, once again, it's a tempered start. We were down about 0.5%, and because of the MSCI rebalancing, yes, yesterday you had a big FII sell figure. So let's see, after just about, defending that 17,300 print, where do we head from here? Because the SGX Nifty seems to be indicating that level at least is going to be well defended to start off trade with. But this morning, the talking points, Nikunj, are all going to be around macros, not just India GDP, but the way the 10-year yield has panned out in just the last month or so, or for that matter, the movement in the US dollar, or for that matter, Brent prices too.
And you don't want this kind of an, macro disruption, if I may, say so. Yeah. When the general view for 2023 was that inflation had peaked out, interest rates will come down, rate hikes will not happen. What do we have? A spike in commodity, a drop in demand, and an uptick in the underlying cost of borrowing, which is the 10-year paper, and a narrative which clearly seems to be endorsing from central bankers that high interest rates are here to stay and Fed will do whatever it takes to stomp growth but bring inflation down. So I'm afraid as we walk into trade this morning, we will have to deal with the word slowdown. GDP is slowing down. Concerns around how the summer of 2023 would move, they've surfaced up. FIs are selling, and globally the handover is slightly shaky. So it's not looking.
Yeah, nothing hunky-dory at all. In fact, just talking about the GDP print, Nikunj, while, we may have expanded in the third quarter to 4.4%, but it has slowed down as against 6.3% in the previous quarter. The center also has revised the GDP numbers for FY22 to 9.1% from the earlier 8.7%. The government has gone ahead and kept the GDP estimate for FY23 unchanged at 7%. And it's interesting because the RBI in December, Nikunj, lowered the country's GDP forecast to 6.8% for the current fiscal. Meanwhile, we also have the fiscal deficit data that was released earlier yesterday, which shows that the deficit for the first 10 months this fiscal has widened all the way to about almost 67% of the revised annual estimates.
No, Aisha, the economy is slowing down.
Yeah.
You just cannot sugarcoat that. And if the print is below 5%, which is, there is a seasonality involved for the quarter gone by, but the fact that we are slowing down and the slowdown blows have hit the economy. It is evident that the peak sugar rush which happened post-COVID, that is behind us. There is a dip in demand and there is a big uptick in inflation. From a market standpoint, the worry is that since we are not done with the rate hike cycle yet, and the fact that rates have already gone back to pre-COVID levels and they are likely to accelerate or inch higher, the demand in the near term will remain subdued. So liquidity is getting tight. Demand is getting punctured, interest rates are moving high, and net what it means that you are in a little bit of a jam. There are a lot of data points in the economy which are showing signs of contraction. There are a lot of data points in the economy which are indicating that things in a sense are really off the mark. Now you can argue back and say, okay, we are growing at 4%, the world is growing at 2%. Okay, that's all great. But what the expectations were for FY23?
That's not average.
Yeah.
We're well below average.
Exactly.
But the thing is whether the market has priced in this economic slowdown already, or at least has priced in a major chunk of it already or not.
Actually, the challenge for us this year has been, I'm just looking at the notes in the morning, just look at what all we've dealt with this year. Adani saga, global inflation coming back, interest rates moving higher, and monsoon. Now, typically when you are getting boxed in a corner, it's very difficult to really determine what the market would do in the near term. Why? Because a lot of these factors in a sense were not anticipated. You can argue the mathematical numbers of the market. Okay, the growth of a company instead of 18 is 15, instead of 18 it's 12. That will have impact on the near term price adjustment, the terminal value changes. But when you have to deal with a global inflation concern coming back and the fact that this year we are in for a harsh summer which will have impact on the which could have impact on monsoon per se, I don't think markets were prepared for it. In hindsight, you may argue back and say that okay, markets knew and markets are smart because the markets in last 1.5 years have not given any returns. I completely buy that argument. The froth in the market is not there, but there is no trigger in the market which will generate upside momentum. So what does that mean? That means that we are going to get boxed here and there. There is going to be very stock specific movement. The bias in the market is not positive. The excitement and participation is not there. So I think we will just linger around here and there, and now everything would be pretty much, you will not look straight, you will look up and just pray when the rain and when the summer will start.
Yeah, and going by the IMD, it's going to be a really hot, hot summer. But anyway, we'll talk about that later since we're on the subject of how the day ahead is going to pan out. Remember, yesterday you did see a sharp crack sub the 17,300 print, just about managed to defend that level actually post adjustment. And yes, FIIs continue to sell. Yesterday, of course, it looked like a bloated figure because of the MSCI rebalancing adjustment. But just looking at the delivery-based selling data as well, Nikunj, the Adani stocks, they continue to see very high delivery. Similar is the case with Reliance, which is almost headed to a breakdown. We're almost 2,300 thereabouts in Reliance. TCS, yes, and HCL Technologies, they of course have covered a lot of ground from the lows.
No, it just tells you that FIs are selling, and there are a variety of factors why FI could be selling. It could be because they're going to China, Indian economy is slowing down, earnings have not been as per estimates. Bottom line here is that FIs are selling. Now, up until now, domestic institutional investors have put a brave face out. So 2023 FIs were selling, domestic institutional investors were buying. The problem is now the investors are feeling the heat. They're getting impatient. Now, I can argue back and say that, look, equity markets will not give you linear returns. Please think long term. But when you are an asset allocator, if you are allocating capital, let's say if you're in family office or if you are really looking at asset rebalancing, equity in last 18 months have not given any returns. Mutual funds, about 75-80% mutual funds have underperformed. So the risk of fresh inflows stalling or the fact that mutual funds are likely to protect cash could have an impact on the market sentiment per se. So what do you do in this market? Well, I continue to maintain that do not try and trade this market. It's not going to be very fruitile experience. Don't cancel your SIPs. I say it again, what is looking like a blown up problem right now, trust me, it will go away 6 months from now, 3 months from now, when the base effect would kick in. And third, I think if one is looking for real leadership in the market, I think the leadership still rests with private banks, it still rests with financials. I don't think it's going to be IT or it's going to be metals.